So, do you remember I said earlier, where is it? We had fiscal and monetary policy. Let's go over to the fiscal policy here. Let's do right here. Fiscal policy. So the fiscal policy is the part controlled by politicians or the president of the country. Right. We'll see monetary policy is usually separate in developed countries, not controlled by the president directly. So what is it? Three things. One, expenditure planning, so spending, how we're going to spend the money. Two, how to get the money. Well, the revenue of the government, what is it? How does the government make money? Tax. Three, everybody forgets this part. Borrowing. How much are we going to borrow, right? With bonds, government bonds here. So you can buy US treasury bonds on the stock market, which is basically the US borrowing money directly from people. Now, spending, each one of these can affect the economy, the macro economy. If the government decides to spend more, the economy will be boosted because of the injection with the multiplier effect, right? We're going to inject more money into the economy, everything is going to be good. If the government spends less, it's going to be bad for the economy. If the government increases tax, it's going to be bad for the economy. If the government reduces tax, it's going to be good for the economy. It's going to be boosted. Same relationship with borrowing, of course. So let's look at tax for a second here. Because as accountants, we should know about this very well. There's a couple of different ways of looking at tax. First of all, it's a source of revenue for the government. Second, it can discourage certain things like tobacco or alcohol by being more taxed heavily, and then redistributes wealth. So some people have too much money and others have too little. So this is a mechanism to take from one part of the population to give to another. And we have for that direct taxation and indirect taxation. Like what? Well, income tax is direct. VAT or sales tax is indirect. Income tax, you pay it directly yourself. Now, if you get a job and a wage in a company, probably your boss does it for you. The company does it for you, and you get your net amount directly as a wage. But if you're a business, you write the check for the tax office yourself. VAT, you only pay VAT when you are the ultimate consumer of the product, right? So the last person in the chain who receives the product and consumes it is the one who's paying full VAT, right? Because between businesses, if you buy something from another business and sell it to another, the VAT flows through and you don't pay it yourself. It's the next person. Another way to look at this is regressive tax. Proportional tax. Proportional tax. And progressive tax. So, regressive, same for everybody. For example, the TV license. It's a flat rate. You need to pay, what is it, £50 or £130 if you own a TV. Everybody needs to pay. Problem with this is that it's punishing for poor people. So I will write that after. Proportional tax, percentage of income, for example. It's in proportion to something. So this is a little bit more fair. The first one is not very fair because if you're very poor, you pay the same amount as somebody very rich, £50. Proportional is a little bit more fair. Well, if you don't earn too much, you're just going to pay 10% of your wage. And if somebody earns way more, he's paying 10% too. The nominal amount is way higher for the rich people. Progressive tax is the best one for poorer people. This one has a higher proportion for wealthier people. So it works like a stepped. So you have different steps. So if you earn between this and this, you don't pay tax. Then if you earn between this and this, you pay 10%. And then if you are above that, between this and this, you pay 20%, etc. This is what we would call a progressive tax. It progresses. And as you can see, regressive tax is not fair. The one in the middle, a little bit better. And the last one is the fairest. Now,